Take a look at these two Amazon investments made in 1997. One puts in $1, the other puts in $500,000. Neither investor trades, neither tries to time the market. They both hold through every market cycle for 3 decades. On a spreadsheet, the percentage returns are identical, but this comparison explores how the dollar amount of that initial bet changes the experience of holding it. A 10% drop looks very different when you lose 10 cents versus $50,000. On May 15, 1997, Amazon went public as a digital bookstore with a catalog of about 2.5 million titles. It was a young internet company with a limited operating history. It had no Prime, no AWS cloud infrastructure, and no global fulfillment network. Shares initially priced at $18. Because of the stock splits that followed, that price is now equivalent to 7.5 cents a share on a split-adjusted basis. To understand the stakes, look at the share counts. The $1 investment buys roughly 13 split-adjusted shares. The $500,000 investment buys over 6.6 million. That massive disparity in shares means every single dollar the stock moves in the future will have a completely different impact on each person's life. Early on, the dot-com boom made technology companies look unstoppable. Amazon stock skyrocketed, and for a long-term holder, the ride looked effortless. Then the bubble burst. Euphoria turned into a free fall, and the entire technology sector began to unravel. For Amazon, the pressure was extreme. Debt concerns and market panic sent the stock plummeting down to about $5 or $6 a share. This is where the psychology of the two investors diverges. Losing 50 cents on a $1 position is a minor detail. Watching hundreds of thousands of dollars evaporate from a portfolio is a life-altering event. For the investor with over 6 million shares, the instinct to capitulate and salvage whatever is left is nearly overwhelming. When a fortune exists only on paper, watching it collapse can force investors to prioritize their short-term survival over their original long-term plan. Amazon survived the crash and began a series of structural shifts, starting with the launch of the Prime membership program in 2005. In 2006, they launched AWS. This marked the moment Amazon moved from a retail store to a provider of the computing infrastructure that runs a significant portion of the modern internet. They were no longer just shipping books. They were operating a global logistics network and massive server farms. Management focused on cash flow over the next decade rather than the next quarter, prioritizing the growth of their physical and digital assets over short-term Wall Street approval. As the business transformed, the market repriced the company's value, rewarding the shareholders who had ignored the years of doubt and volatility. Along the way, the shares multiplied. Amazon issued a 2-for-1 split, a 3-for-1, another 2-for-1, and a 20-for-1 split in 2022. Each original share was eventually divided into 240 pieces. These splits simply divided the same ownership into more shares as the company's total valuation rose. By August 2026, after years of growth in cloud computing and AI, Amazon crossed a $3 trillion market capitalization. Compounding growth and a complete transformation of the business model eventually put early shares at the top of the global market. Building. Now we can look at the final numbers. Based on a share price of $272, the investment has grown by roughly 3,627 times. For the first investor, the single dollar they put in has become approximately $3,627. For the second investor, that initial $500,000 is now worth $1.81 billion. That final outcome is only possible if the investor can watch a paper fortune disappear during a crash and still choose to do nothing. So be honest. Could you have held that position through every downturn? We're taking this experiment to the entire S&P 500 next. Subscribe so you don't miss the reveal.